Hello, we are Fabulous Five from the University of New Brunswick, and we will present to you our strategy for the CQA challenge. So we will be introducing our investment team, talking about our investment philosophy and process, our portfolio construction and trading rebalancing frequency, our portfolio performance, our portfolio attribution, and risk and return expectations. So in our investment team, we have myself, Molly Grace Pittman, Michael McSorley, Dhruv Argawal, Shashank Goli, and David Sun. So to create our portfolio, we chose to use factor investing. We chose value and momentum as our two factors. The value factor captures excess returns to stocks that have low prices relative to their fundamental value, whereas momentum reflects returns to stocks with stronger past performance. The other factors included in factor investing are size, low volatility, quality, and global equity. When looking at factor performance during the time period of the first quarter in 2020 and the third quarter in 2020, we can see that the value and momentum factors work opposite of each other. Looking at the global factor correlation graph, we can see that they are negatively correlated. It is because of this that we choose these two factors. When constructing our portfolio, we made the decision to place equal weight between both of our factors. This is because we wanted to invest in stocks in which we were winning over the prior 12 months and were relatively undervalued. When determining our investable universe, we chose the Russell 2000 Index, which measures the performance of stocks in the United States with small capitalization. Given that our chosen factors are value and momentum, we identified price to book ratio, price to free cash flows ratio, and price to sales ratio as relevant variables for the value factor, and relative share price momentum as a relevant variable for our momentum factor. To determine which exact stocks to invest in, we calculated a Z-score to standardize the values. We did this for both of our factors, value and momentum. Once we had the Z-score for each factor, we calculated a Z-score that comprised an equal weighting of the stock Z-score from each of the factors. We then chose to long 5 stocks from each sector with the highest combined Z-score and short 5 stocks with the lowest combined Z-score from each sector, in an effort to construct an equal weight sector portfolio. Of course, if they did not meet compliance, we took the next in place for each position. From there, we took the last price of each stock to determine how many shares of each stock we were going to short or long. Again, we chose an equal weighted sector portfolio, and this is how we constructed our portfolio.
So using the equal weighted scheme, Team Fabulous 5 constructed a portfolio that consisted of stocks from 11 sectors. The initial starting weight of each stock was approximately 0.909%, or in terms of market value, it would be 9,090 USD. With regards to the portfolio trading rebalancing frequency, after the construction of our portfolio was completed, using value and momentum factors, we decided on a buy and hold philosophy. We wanted to hold because we were expecting a recovery. Our goal was to achieve active returns with the help of value and momentum factors. However, this was not the case. Subsequent trades were utilized to meet compliance requirements of the competition. For example, some shares of our best performers, Bloom Energy and Novavax Incorporated, were sold because they exceeded the market value requirements for the competition. Other trades were performed because some companies were no longer listed publicly for trade.
So in terms of our portfolio performance as of 17th March 2021, we had a Sharpe ratio of 1.26 and beta of 0.4. As you can see in the graph that we had an upside down journey, but at the end we did achieve a cumulative active return of around 8.4%. Talking in deep, until the first half of the competition, we were underperforming the SPY index, but then a shift to the value from growth helped our portfolio returns to outperform the indices. This outperformance is also supported by our equal weighted sector allocation strategy. The second half of the competition witnessed an increase in the bond yields, which resulted a move out of tech stocks to the more cyclical stocks. This really helped our portfolio. Moving on to the factor contribution, it was observed that the style factor was the biggest contributor to the active return. Industry and market were kind of neutral. In the beginning, when we started our portfolio using the style factor, but over the time, when we were making trades to keep a check on the compliance, we started to move towards sectors performing well, and that led to an increase in the stock specific return. So this strategy really helped us. Moving on to the talking about the actual returns and risk. So out of 8.42% active return, around 3.8% was the specific and 4.5 was the factor. And in that 4.5, the style contributed the major chunk of around 4%.
I will start with the details of the style factor. Value had an insignificant impact on the active return of our portfolio. Medium-term momentum had a mean reverting trend in the beginning, but starting on a year-to-date basis, it had been underperforming, and that's caused for the underperformance since the beginning of this year. And the highest contributor was market sensitivity, or beta, and it mostly helped by making trades in those stocks which performed well in the economic recovery phase. For allocation effort, which is the most important part in the portfolio attribution, it refers to the returns generated by allocating portfolio weights to specific sectors. Our top 5 contributors to active return by industry are water utilities, REITs, oil, gas, consumable fuels, and media, and the real estate management and development. And top 5 contributors to active return by sectors are real estate, consumer discretionary, utilities, materials, and information technology. These contributors helped us to outperform, and there are also some underperformance of the momentum factor. We have a negative contribution coming from the energy sector because we have an active average weighted exposure to energy. Since energy outperformed over the period, we have a negative contribution coming from the sector. Same goes for the financial sector.
So looking at our risk analysis and overview, our portfolio was at risk of 14.53%, which is almost double that of the CQA index at 7.47. This is made up of active factor risk, which is related to the sensitivity of the factors to benchmark. We came in at just over 80% compared to CQA at 52.98, and active specific risk, which is related to the weights used by us compared to benchmark. We had 19.98 and CQA had 47.02. So looking at the active risk decomposition, as you can see, we had active risk of 14.53%, specific risk being 6.49, and factor active risk of 12.99. And as Drew mentioned, we had good returns there, but with good returns comes great risk, and our style factor was 12.79. Our portfolio is mostly made up of a balanced of all sectors where the CQA index was not. So looking at those style factor risk exposure, you can see most of our active risk was made up of medium-term momentum, and the CQA index was actually the size. So that's where we get the biggest difference compared to the benchmark. And the risk and return expectations, as Drew mentioned, our performance versus the Russell 2000 was quite low overall. So to change that, we believe that value is expected to outperform. So we'd like to rebalance our portfolio to be more value weighted compared to the momentum. Momentum is more volatile. So as mentioned, with high returns comes high risk. We also believe that there are some market concerns in terms of inflation coming out of COVID, as well as interest rates rising. So to conclude, we'd like to thank everybody for attending, and have a good day.